Hello, welcome back to our channel, my friends. Today we have very special topic. We're gonna address this cyclical adjusted price to earnings ratio, right? This probably you already know what is the price to earnings ratio, okay? Which is the stock price over the stock earnings on the next 12 months, right? Okay, so today we are gonna study and we're gonna analyze a slightly different one, which is the cyclical adjusted, and the main difference is that we're gonna compare the stock prices as well, but we're gonna compare it over the stock earnings, but not on the next 12 months, but on the next 10 years. That's also, that's why it's also known as a smoothing indicator, right? Because it isolates the cycles effect, right? Basically, it's quite similar, but we are looking over the next 10 years earnings, and we are isolating the cycles effect, right, in the economy. Right now, let's go straight on to this. By the way, we are gonna read today this T favor paper, which is from, by the way, it's a quite old one. It's from August 2012, but that's not an issue at all, because it's completely useful nowadays. Okay, so let's go to this graph, which shows you this cyclical adjusted price to earnings ratio, which goes from 0 to 50. And we compare it with we'll analyze over the 103 years, right, from 1881 to 2007, right. Of course, if we plot this up to today, right, which we are in 2026, we'll have something like this. Nowadays, at this point, we are around the 40s. Okay, we are around here. So and then you have this red line, which is the average, right? This is an average reading over the last 130 years, right? Which is a huge amount of data. And the red line, which was the average by 2007, right now should be a little bit higher, right? But when this paper was written, which was 2007, it was around the 60s, right? Now 16, right? Now should be around 17, 18, probably keeps between 15 and 20. Okay, so here, this is the here you have the bubbles dot crisis, right? Where we have an extreme reading, almost getting the 45, and here you have on the 1917s, 1920s, right, reading below 5, right, and then after the big depression, we had to gain readings below the 5. Okay, so this is are the opposite extremes, right? But in the expected value of this cyclical adjusted price to earnings ratio, it's between historically between 15 and 20. Okay, so right now, today, 2026, we are around the 40s, so we are at extreme valuations, right? By the way, I didn't tell you, but this is USA stocks. Okay, we are these data are from the US stocks. Okay, so now let's go on. Let's scroll down and let's focus now. Let's focus on this interesting table. Okay, here you have on your left column, you have classified in blocks of 5, right? The cyclical adjusted price to earnings ratio, below 5, between 5 and 10, between 10 and 15, so forth, so on, and finally between 40 to 50. Okay, and then here you have on the second column you have the probability of being below 55, which is the below 1% chances, okay? And then, for instance, you have that the cyclical adjusted price to earning ratio between reading between 15 to 20, you have 31% chances to be on this lecture. So today, if we are in 40, right, on the 40s, this is a very, very rare. It's a very rare situation, right? So it's not common at all, okay? So we will see now, okay? But if you are on, what this table tells you is that if you buy your US stocks, and this data again are from the last 130 years, so it's a huge bunch of data, right? So if you buy below 5, on the next year, well, this is 1 year forward real compound annual growth rate, you will find you will have a 25% return next year. But in 3 years, you will have an average, this is an average, almost 90% return. On 5 years, 21, 7 years, 22, and on the next year, 10 years, you will have almost a 16% annual return, which is amazing, okay? It's amazing. But on the other hand, on the opposite side, right? If you buy between 40 and 50, right? Next year, you will expect a minus 12% return. On the next 3 years, you will expect a minus 17. So far, so on. On the next 10 years, if you buy today when the cyclical adjusted price to earnings ratio reaches 40, you will expect a 10-year forward real annual world return of minus 3.5%. Okay, so at the end of the day, this is telling you, okay, buy at 40, you will expect on the next 10 years a negative return, which is a completely miss. Okay, so well, this was basically what I wanted to show you today. This is a very good summary of what are your returns expected. Always expected returns. These are expected values. If you buy at these cyclical adjusted price to earnings ratio values, okay. So what do you think? Is this? I guess it's an amazing indicator. Of course, then the paper, well, will show you if stocks looks like cheap or expensive, depending of where the cyclical adjusted price to earnings ratio is, which is the same as we've seen before, and then analyze or study same thing but considering different countries, right? It's quite interesting study. You can take a look, of course, and same table we've seen before, but for a study of 32 countries. Okay, I will leave you the link down below in the description comments box, right? So if anyone is interested, you can go directly to the paper and to study it in detail. Okay, well, I hope this had been this was interesting for you, and of course we will wait you on the next videos to look for more interesting data and strategies to keep investing successfully. Keep in touch. Bye bye.